The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A cooling labor market puts a chill over financial markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to closing bell here in the U.S. And as Romaine said, it certainly looks chilly out there. The S&P 500 down by about 0.7%. And you can see it's really risk off across asset classes right now. Your big tech names down about 1.3%. The Russell 2000, where your small caps live, down about 1.3% as well. Interestingly, those small guys not getting any lift from this downdraft that we're seeing in Treasury yields. 10-year yields down about 7 basis points right now, Romaine. Clearly, investors looking for some safety here. Yeah,
the story today, believe it or not, is actually about the AI revolution, an AI revolution that spurred one of the strongest stock market rallies in 3 decades. Well, it also spurred the most U.S. job cuts for an October in more than 2 decades. That was the data from outplacement firm Challenger Gray this morning that rattled markets and tipped it towards its first weekly loss in 4. While some investors are retreating, Kate Moore over at Citi, she said she's fading the data.
We think the labor market is fine, but is a little bit more frozen for the obvious reasons we've been talking about. And I think as we get more AI use cases and people understand whether or not there's efficiency and productivity gains as a result of these investments, we might see a slightly different job market in 2026.
Well, some folks aren't waiting around for 2026 to find out. The flight of money from stocks is being matched by a flight of money into bonds. That's partially a safe haven play, but likely more so a bet on further Fed rate cuts. But Cleveland Fed President Beth Hammack says, hold your horses, flagging the risk of embedding high inflation into the economy and arguing that the Fed's attention should actually be leaning more into that problem rather than that labor market weakness. Now, all of this is transpiring on a day when the S&P companies continue to post surprisingly strong earnings, 14% growth as a group over last year, almost double analyst expectations. And it also comes on a day where the National Retail Federation put out some surprisingly sunny forecasts for the holiday shopping season that started November 1st. Spending estimated to jump 4%, Katie Greifeld, and surpass $1 trillion.
So some interesting good news there when you think about that upcoming holiday season. But this chart behind me could point to weakness ahead if we see that labor market weakness continue. That labor market weakness that Kate Moore isn't worried about. But I have behind me a chart of those Challenger job cuts. And you can see that in October, they rose to the 3rd highest level since 2020. You can see they just started to pick up over there towards the left, I guess right for you, of the chart. 2020 really distorts everything. If you just imagine that this isn't here, basically, you can see much more that we have started to see things tick up a little bit when it comes to job cuts. We got some higher bars when it comes to March, potentially April that time frame, but certainly October. It seems like once again the levels are on the rise, Romaine, and the big question is whether or not this is going to continue and whether this is going to command more of the Fed's attention than maybe that embedded inflation in the economy still.
All right, well, let's kick things off to the close with Alli McCartney, Managing Director of Wealth Management and Private Wealth Advisor at UBS Alignment Partners. All right, Alli, obviously everybody today is really focused on these labor market numbers, and that's really in the context of what the Fed does next. We're seeing that drop in yields today, a 10-year right now, right around 4.1%. Do you think that the direction that we're going to see in the Treasury market right now with regards to yields is going to be lower than where we are right now?
We do. So we think that you're going to see a 375 by mid next year. What you're dealing with now is exactly what you've been talking about and what my gorgeous friend Kate said earlier, which is there are 2 major forces that have been moving markets, both equities and bonds, and those are Fed directionality, which depends on labor and inflation, and earnings growth. Today is one of those days where both are being addressed. So there's murkiness in the labor market. That sort of pushes you one way from those Fed tailwinds. And then you have a risk-off day. It sort of makes sense that we've had some risk off this week because a lot of asset managers have October year ends. So I think that that's one thing not a lot of people have talked about in terms of some risk probably came off of the table at the end of the month, which puts us into here. But we're in this quiet period between having most of the mega caps having reported and NVIDIA and a December Fed meeting. So, that's, I think, what's giving people pause right now.
Yeah, I think we need to talk to Jensen Huang and get them to move their earnings to like the start of the earnings season, just to get it out of the way, because that's all everybody cares about these days. In all seriousness, though, I mean, you mentioned the rest of the earnings season, which actually is going to include a lot of the retailers and a lot of consumer-facing companies. And that data's really been mixed. I mean, the National Retail Federation says, okay, we're going to spend more. I know some of that's inflation because of inflation, but you're not really seeing anyone forecasting a massive drop-off in consumer spending. No,
you're seeing some really healthy behavior on average, and I think that's one of the conversations we can have, who and what is average and how meaningful is that in the terms of the numbers that we see. And we continue to see growth, although it's probably waning growth, decelerating growth. But, we have a really, commerce is happening.
Yeah.
Decreasing interest rates should hopefully make it easier, especially for the low-end consumer. But you have seen, whether you're talking about McDonald's or Chipotle, you've seen outside of some of the mega cap technology stocks, you've seen some winners and losers, and they are certainly pointing at, lower-end consumers being pressured. And when you have something like a government shutdown, when you have potential increasing inflation impacts from tariffs, these are real headwinds to the ability to spend.
Well, I'm glad you brought up McDonald's, because I think that's a really interesting sign of the times that they saw the cohort of lower income consumers actually decrease their spending. It was more of that trade down from higher income brackets that seemed to benefit McDonald's. But I want to talk a little bit more about tariffs, because there's this idea out there that you've seen companies really eat a lot of the costs, that they haven't been passed on, maybe to the degree that some economists were worried about. You aren't really necessarily seeing that show up in earnings, though. So I just wonder where we are when it comes to the tariffs' impact on the economy.
So it is certainly true that given that the numbers that were out there for the magnitude and the pace of the tariffs, we have seen less magnitude and a much slower pace. But I think we're going to see that going into 2026. Because of the tenuousness of whether it's politics or the economy right now, it seems to me that a lot of companies have been more willing to eat that marginality than pass it on. I think you will increasingly see over probably the first 2 quarters in 2026, this pressure on margins start to pressure the consumer.
So we'll have to stay tuned on that one, especially given that, the IEEPA tariffs are being challenged at the Supreme Court right now. But before we let you go, I do want to talk a little bit about the interaction between the equity market and the bond market. Today's a good example where you have folks selling stocks going into bonds, but bonds, where role do they play right now? It feels like they've been an unreliable hedge, and a day like today, maybe they're coming back. But overall, I mean, how are you thinking about the bond market?
So that's the right question to ask. I actually had a meeting with a client this morning where we sort of looked at the portfolio, and he said, well, if everything stops going up at the same time, what will my portfolio do? And the experience has been that whether you owned bonds, commodities, equities, whether they're global equities, whether they're small, everything has gone in one direction. I think that we are about to go into a period, given some of the conflicting murkiness we're getting. Talk about the job market. We have one measure that says, things are looking tougher. We have one that says payrolls are going up. I think that ballast that should exist, right, when you think about true diversification, portfolio theory, why we build portfolios the way we do, my guess is that into year end, but again, certainly in 2026, that we see a more normalized relationship between these asset classes in terms of, and that's also been, there have also been issues in terms of the politicization of owning treasuries, the U.S. dollar, you name it. But in 2026, I think having discipline and diversification is going to be cool again.
There you go. You heard it here first. Make it cool again. Alli, always great. Alli McCartney, Managing Director of Wealth Management and Private Wealth Advisor at UBS Alignment Partners, kicking us off to the close, where for today we have a big focus on the health of the consumer. A day after we learned consumer debt delinquencies at their highest level in 5 years, we're going to give you the lowdown on loans and what we're really seeing when it comes to consumer credit. The CEO of Lending Club, Scott Sanborn, he joins us after the break right here on The Close. This is Bloomberg.
Consumer finance stocks slumping in recent weeks as cracks begin to emerge in the consumer credit space. Our next guest has a unique perspective on this as the CEO of Lending Club, a company that offers a variety of loans for their clients and has recently expanded into home improvement financing. Scott Sanborn, he is CEO at Lending Club. He joins us on set right now. Scott, great to see you in person.
Thanks for having me.
So set the scene for us here, because as I mentioned, you have seen some cracks start to emerge, a lot of concerns as well. Give us a read on the type of client that you serve and what the current state of play looks like.
Yeah, and what I distinguish is cracks in the job market, not cracks in credit. You've seen a lot of the private credit people have reported, most of the banks and finance companies have reported, and the consumer is showing themselves to be very, very resilient. Certainly the consumer we serve, which is they represent people with an average income of about $125,000 who make heavy use of credit going with their high income, and we've seen very, very stable performance for several years now.
Well, as I mentioned, you recently launched home improvement lending. This is interesting because it's not mortgages that you're providing here, but help me understand. So if I wanted to add a deck to my home or something like that, Lending Club is now in a position to extend a loan to me. Not that I have a home to add a deck to, but anyway. Yeah,
that's right. So, an unsecured personal loan you can use for anything. One of the core use cases we offer is people to pay down their credit card debt, which is at a record high. But people also use it to make purchases, large ticket purchases. We're already in a B2B2C space where we help people afford, elective treatments like fertility treatments or braces for their kids. And so this is a natural extension of our underwriting capabilities to this category. We've acquired a company called Mosaic, which is a code base and a team. And so we're going to be basically applying our leading underwriting capabilities to this use case so that, when you're in the process of, renovating your home, you basically have access to instant credit.
Did you have to make improvements to your underwriting procedures as you took on this new business?
Yeah, they require a slightly different, these are larger loans, which we make today, but they also require the ability to disperse it in stages and to be able to disperse it to multiple providers. So that's some of the feature and functionality that we're adding.
Now, just to get a feel for what your customers are doing, are you finding that most of the borrowing that they're doing and in effect the money that the things that they're spending that on, is it more on discretionary type things or things that are a little bit more essential? And that it could even include something like I said, braces for kids is basically a necessity.
Yeah, so our customers are very deliberate, responsible borrowers. And if you think about the income split across the US Census, really high income people, they can pay cash. Lower income people don't have as much access to credit. There's this, what we call middle majority that we serve that make heavy use of credit. They over-index. They're more likely than average to have student loan, car loan, unsecured loan, credit cards. And one of the largest use cases for us is actually people who put in expense. The dominant way people access unsecured credit is a credit card. Yeah. Interest rates are currently at 23% if you're carrying a balance, which is the highest rate it's been in history. It's nearly doubled over the last 2 decades. So we find those people and say, hey, you have a loan, it's not a good one, do this instead. We save them about 30% off their interest rate.
Do you think that the economic conditions, assuming that they are weakening, as some of the data suggests, does that help your business? Meaning, does it drive more people to you, or do you have to retrench too?
Well, our ability to provide savings is helpful in any environment. So we certainly see, when we can knock down their payment pretty materially, save thousands of dollars in interest. So it works in any environment. And I'd say right now the demand is high just because those credit card balances are high and those interest rates are very high.
Well, that's something I was wondering about because, Scott, if I take a look at your resume, so to speak, I mean, you've been at Lending Club since 2010. You were appointed CEO in 2016. You've seen a number of different interest rate cycles at this point. So now that we do have interest rates actually coming down from a pretty lofty peak relative to at least recent history, I mean, how do you see that evolving in 2026 as this rate cutting cycle really gets underway?
Yeah, it's a positive for us and for our customers. It's a tailwind. It allows, it triggers, it wakes people up to the fact that rates might be moving. It makes them aware that there could be the potential for savings. And when they go online to look for savings, they find us. So that's a positive. It'll help boost our margins, net interest margin. We also, in addition to the bank balance sheet, we also have a marketplace business where we sell loans to banks and private credit. And so as the cost of capital comes down for them, that's also a positive in terms of boosting the sales prices on the loans.
Yeah, and we should point out, I mean, you're here in New York for an investor day. Investors
That's right.
receptive to the message that
they sure were. Where the stock ended up 8% yesterday, we were able to really lay out, for the first time since acquiring the bank, kind of how our strategic potential has evolved.
All right, Scott, appreciate you coming in. Scott Sanborn, the CEO there of Lending Club, as we move closer to the closing bells, just about 43 minutes away. And we're going to talk a little bit more about earnings. Stick with us. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations, and we start with CarMax. JP Morgan cutting to underweight, setting the price target at a street low $30 a share. The downgrade coming after an earnings miss and news that the CEO is going to be stepping down, a move the analyst says wasn't entirely a surprise given earnings haven't grown in about 10 years. Those shares right now having their worst day since 2022. Next up, let's take a look at Bumble. RBC downgrading to sector perform and reducing their price target to $5 after a, quote, challenging earnings report. The analyst has concern that online dating faces significant secular challenges up ahead. Those shares taking a big drop down, having their worst day since February. And finally, Elf Beauty. Piper Sandler cutting to neutral from overweight and slashing the price target to $100 from $150, despite the belief that road sales could see upside. The analyst says the outlook for sales of core Elf products in fiscal 2026, well, that looks a little disappointing. Investors disappointed as well, sending the shares down 35% for the worst one-day drop in the stock on record. We had a chance to catch up with the CFO of Elf Beauty a little bit earlier here on Bloomberg Television. Well, she was a little bit more upbeat on what the earnings showed. Let's take a listen.
We just issued guidance for the first time this year. 18 to 20% net sales growth is what we expect. And I would say if you look across consumer and think about the consumer backdrop that we're operating in, 18 to 20% is pretty awesome.
And that was Mandy Fields, the CFO of Elf Beauty. Joining us right now is Andreeva, senior research analyst over at Piper Sandler, who covers this stock. And, 18 to 20% growth. Does that not sort of get you excited?
No, thanks for having me. Great to be here. I mean, listen, I don't disagree. Road asset, we're big fans of. Company talked about 40% sales growth, a guide for road for this year. And we actually think that could be even better than that. The brand just has a lot of momentum and obviously new door opportunity as well. But what we worry about is the core Elf. This is not an inexpensive stock, and you really do need both organic business and the new asset to be working simultaneously. And Elf just disappointed, growing or rather declining this past quarter. And the company also, guided profitability much lower for this year on the road investments, and the market was not expecting that.
I am curious, too. There was an interesting number where it came to their international business. I know this is primarily a U.S. company in terms of where it sells its products, but there was a significant drop-off in growth from double-digit percentages to low single-digit percentages. Does that concern you as well?
Yeah, no, for sure. I mean, that was part of our downgrade and part of our thesis that, international has been this double-digit compounder for really quite some time now. This is a great value prop, right? The Elf brand, and there's a lot of white space for this company. So to see this kind of a drop off from 30% growth the previous quarter was, definitely a question mark. And, as we think about Elf's market share overall of the industry, it's still under 20%. The industry in the United States, including in mass, has improved sequentially, but yet, we saw this step down with Elf, and we think that is a concern.
So even with this drop today, 31%, it sounds like you're saying that this isn't an inexpensive stock by most measures. And Anna, I wonder how much of this is Elf being sort of a victim of its own success when you think about some of the comps that it was up against.
That's definitely part of it. The one aspect of this business that we're watching closely right now is innovation. So the beauty industry responds to innovation very strongly, right? Like usually, no matter at what price, if the innovation is right, the consumer converts. We question a little bit, has, innovation from e.l.f., potentially gotten a little bit less robust as of late, and there are other competitors out there in mass that are more on offense. We think that could be part of it, but that certainly is something we're watching closely. If you do see some pickup of innovation as we go through the next few quarters, I think that would be constructive for the business.
Well, to that point, innovation, that's what you want to see from this company. Is that something that they could theoretically go out and acquire? It seems like the sell side is pretty upbeat about what they're seeing with Rhode. Or is this something that you want to see e.l.f. develop in-house?
I think that's the latter. Generally with a kind of a portfolio, type companies, just adding, new assets is not necessarily a road to success. I think you really want to make sure that the core business, that the organic business in the U.S. and internationally is having some momentum. And, we're certainly watching the consumer as well. Chipotle the other week, talked about the younger demographic that is spending less. This morning, Warby Parker echoed, some of those comments as well. So we are wondering, what's happening with that 25-year-old and younger, type of a demo that, e.l.f. certainly is very levered to as well.
Well, I'm also curious about that, and it's a good point. And you have pretty broad coverage in the consumer space, but there's always been this idea that during economic downturns that people tend to still hold on to beauty and skincare products. The idea that it ends up becoming that sort of one affordable luxury, if you will, in an otherwise dour economy. Does that not potentially work to the benefit of e.l.f. and its peers?
I definitely do agree with that. And, this is an emotional category, and we do love, e.l.f.'s positioning. This is, a $6.50 on average, price point that they just raised by $1, in August. And they had some pretty good things to say about the elasticity. So again, I think when the innovation is right and when the product is right, I think the consumer is ready to convert. So, specific categories that they've talked about, lip as well as skincare. This is, at the core e.l.f. Brand as well as eye. Those three are relatively underpenetrated compared to some of the others. So that's where we're watching, to see some of the bigger innovation ahead.
All right, Anna, great to get some time with you. That is Anna Andreeva, Senior Research Analyst over at Piper Sandler. Coming up, we'll be speaking with the CEO of Tanger, Stephen Yalof. Stay tuned. This is The Close.
A crisp day here in New York City, 3:30 p.m. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld, keeping a close eye on the markets, but also keeping a close eye on the consumer. Romaine Bostick, some interesting reports out from McDonald's and Chipotle earlier this week, maybe casting some concern. But then you think about some of the apparel makers just doing fine. Yeah, Tapestry was out with earnings this morning. I know the shares aren't doing well, but you're talking about 16% growth on the top line for that company. And of course, that company's made a nice little rebound for their Coach business, and that'll carry over. I was also taking a look at some new data out by the National Retail Federation, kind of projecting what they expect holiday spending to look like. It was relatively sunny. Yeah, $1 trillion. $1 trillion, 4% year over year. I know the inflation is kind of baked into that, but it's still more than what we did last year. Yeah, so folks still planning to spend, maybe not as much on fast casual restaurants, fast food, but maybe still when it comes to other goods in this economy. This year? Is it? I don't know. I never know. Don't ask me. I always go to the TikTok gift guides. But in any case, let's keep the conversation going now with Stephen Yalof. He is president and CEO of Tanger, which houses outlets from both brands. Stephen, great to see you in person.
Thanks for having me back.
So you're known for these open air shopping centers. As I mentioned, you have a portfolio that includes both Tapestry and Ralph Lauren. As we really get closer and closer to holiday season, maybe it's already started in your view, what are you seeing in terms of traffic and trends when it comes to this consumer?
Well, first of all, holiday shopping has started. Halloween decorations.
Does it ever end?
Well, you know, Halloween decorations, well, you know, these holidays are so important in a shopping center now. You know, we talked about back to school being the second biggest shopping holiday of the year. Then you go right into Halloween, which is really important, particularly in the open air shopping centers, because it's a safe place for families to bring their kids to go trick or treating. And then 31st of October, the Halloween decorations go down, and the Christmas decor comes up. Not only that, our trees are up, the music is on, and the season has started. And we start with our first promotion, and that's Black Friday every day of the month of November. We're pulling the season forward so that some of those folks who you were talking about earlier, that, you know, maybe some of the younger consumers that are a little bit more concerned have an opportunity to catch value.
I just want to say that light switch flip that you see on that. I mean, there was like one of those Halloween stores near our house. October 31st, 2 days later, walked by the same place, and it was decked out in Christmas gear. They had cleaned out all the Halloween stuff, and it was already Christmas.
I gotta say, Hoboken, you're still seeing a lot of cobwebs there. I don't think people have gotten out their Christmas decorations yet. But to that point, promotions. How is it shaping up to compare to last year? Because we have yet another year where inflation, it's come down somewhat, but still we're sitting at overall higher levels, and the rate of change too has still been pretty sticky.
You know, in the outlet space especially, and that's really our core business, the retailers have a tremendous amount of flexibility to flex their pricing. So it all starts with inventory. And when the stores are stocked with inventory, you know, you can't sell what you don't have in the store. It gives the opportunity for the retailers to check out pace. If they're turning goods, they're going to hold their price. But if they feel like they need to stimulate traffic into their stores, they're going to break their price. And we'll see that happen a little bit earlier if traffic's off. But if October's any indication, and at least the first weekend of November that we've seen, the traffic is still continuing to build.
So you're anticipating, at least with regards to the foot traffic on your properties, that will be higher than what we saw the last holiday season.
Yeah, look, we're really optimistic for a number of reasons. First of all, like I said, there's plenty of inventory in the stores, so you can't sell it if you don't have it. Critically important to the retailers, but more importantly, you know, we talk about inflation and we talk about pricing keeping up with inflation. You know, I think there's a deflationary economy in the outlet business, in that the retailers have the opportunity to bring that price down to a certain level that reaches the customer. And when you see the price break, you know it's because they're driving customers into this.
When you talk about inventory levels, because obviously there was a lot of concern earlier this year with regards to the tariff uncertainty and the relatively long lead times you need to get stuff from overseas. So as we head into those stores now, basically everything these stores need more or less for the holiday season, you're saying they basically have.
Yeah, I think a lot of that product had already been landed a quarter ago. And, you know, some of the retailers that were, you know, sort of flexing their pricing with tariff might have flexed their pricing as early as the second quarter. Even though there wasn't any tariff impact, they were testing their pricing, and also there was inflation, so they were building their pricing accordingly. But, you know, what we saw when tariffs were first announced at the beginning of April, we've seen traffic build. It built through the summer. We had that early summer promotion to bring back to school shopping a little bit earlier this year. Great promotion for us. Totally drove traffic during the entire summer. We're going to do this other program I just told you about in November. But again, I think the customer's looking for value. They want the brands they want. They want the products they want. And, you know, in our shopping centers, it's more than just shopping stores. You know, we now have food and beverage. We've elevated the food offering. We've elevated the entertainment offering. We now have services in our shopping centers too. So a local customer who may come for a spin class can stay for the shopping.
So it's a whole experience there. And I do want to talk a little bit more about your business. You recently reported earnings. This number stuck out, that your quarter end occupancy was 97.4%. How much of that is lease renewals versus you bringing on new partners and signing new leases?
Well, it's definitely a mix of the two. You know, in order for a tenant, first of all, there's a couple of macro things that are happening in the marketplace right now. Really important to understand, particularly as it relates to our portfolio. There's not a lot of new retail space being delivered in the market. And what that does is it causes each square foot of space in our portfolio to be that much more valuable. Because of that, retailers, they want to renew. If their stores are cash flowing positively, if that store is fully amortized, the construction of that store is amortized, who wants to close that store? but it gives us the opportunity to really push rents. And that's what you're seeing in our growth of our NOI. You're seeing that in our transaction volume. And for us, we have to make some tough decisions. Now, there's retailers out there that might not be keeping up. Perhaps they're not reinvesting in their brand. Perhaps they're losing market share to some other better, cooler, newer brands. I think it's up to us as sort of the stewards of the shopping center, as the merchandiser of the center, to make sure that we're constantly bringing in new brands, the brands that the consumer wants. It's a two-way street. It's not all about the guy who can pay the most amount of rent. It's really, you want the brand that's in that shopping center that can draw the most amount of traffic, but just as importantly, draw the retailers that want to be in your center as well.
But also getting that foot traffic, it also means offering things beyond just the retail, if you will. And you mentioned going for a spin class and services. You have a partnership also with basically Unrivaled
That's right,
Sports.
Unrivaled, yeah.
And I am curious as to whether you see that translate. So if people come and they bring their kids in to play games at Unrivaled, did they then go down down to the next store and buy a T-shirt or shoes or whatever?
Well, that partnership, it's a great partnership for us. Now, remember, we've talked about it in my visits in the past, that what's unique about the outlet platform is that it's incumbent on us as the landlord to drive traffic into our shopping centers. We don't rely on the brands to use their marketing capital to say, hey, come shop us off price. We're basically, what we're saying is, we'll do that heavy lifting for you, and we're going to go out into the market and we're going to make sure we're driving traffic. And one of these great partnerships, the Unrivaled Sports partnership, if you know what they do, they host a lot of these travel tournaments for travel teams, kids from 5 to 18 that have teams in their communities that come to these tournaments to up their level of competition. Well, they do, it's lacrosse, it's soccer, it's football, it's basketball, it's tennis. And for us, we're quite proximate to a number of these venues, and that cross-promotional opportunity gives us a chance to, host the receiving when these folks come for that tournament. We'll hand out bags. We'll welcome them using our shopping center as a venue to greet these folks. But similarly, when they're there, if they have a game at 10 o'clock in the morning and then another game at 2 o'clock in the afternoon, there's something that they're going to need to do between those two times. One of it's going to be shop, maybe it's our dining opportunities, and maybe it's our better entertainment. Yeah. We're looking forward to really playing this partnership out.
All right, Stephen, always a pleasure.
Thank you for having me on.
Stephen Yalof, he is the CEO over at Tanger. All right, when we come back, we're going to turn to healthcare. A lot of activity in that space, particularly in shares of Novo Nordisk and Eli Lilly, striking big deals with the Trump administration that could potentially reduce the cost of those GLP-1 medications for millions of Americans. That's our stock of the hour, and it's up next. This is The Close on Bloomberg. Time now for our stock of the hour. We're in the healthcare space, taking a look at the ADRs of Novo Nordisk, down here on the day by about 4%. This after making a deal with the Trump administration to slash prices for weight loss drugs. That's in exchange for tariff relief and wider access for Medicare patients. The pharma giant also increasing its offer today for obesity startup Metsera as its takeover battle with Pfizer heats up. A lot going on. Let's get to Norah Mulinda to help break it down for us. First, let's start off with the GLP-1 drugs. Anyone thinking about this right now? You look at the costs. The idea is that tomorrow or at some point in the near future, you're going to pay less?
I mean, that's the question here. We are hearing this deal with President Donald Trump, and there's a lot that we have to really dig into with a lot of these drug makers. But what I'm really looking at is the performance between Novo Nordisk and Eli Lilly here. I mean, Novo Nordisk was the first one to come out the gate, really hammering in, trying to pull out some obesity drugs opportunities. But we are seeing them really lagging behind the likes of Eli Lilly. You're seeing Eli Lilly boosting their outlook in terms of sales, their third quarter sales outlook, and also just seeing Novo Nordisk cutting it. So you really are seeing a bifurcation right now in performance, despite the fact that Novo Nordisk was essentially one of the pioneers.
They're like the Uber and Lyft of the obesity drug market, and certainly saw that baton being passed to Eli Lilly. Now they're the dominant GLP-1 maker when it comes to U.S. market share, but that's part of the reason why you see Novo Nordisk going so aggressively after Metsera. That is that obesity drug startup. What is the latest in the bidding war, the battle with Pfizer?
Well, this has been a really interesting one to watch between the two, but it's really about who can pay more. Of course, they're both kind of duking it out because this is a next generation obesity drug. So you really are looking for people, or we're looking at these companies really trying to see who can move ahead, who can be the most competitive. And so it's really about who's willing to pay the most. And of course, hopefully a decision should be coming in the coming days here.
Is there a sense, though, I mean, what do investors want to see? I mean, would they rather, I mean, based on the price action, would they rather this go slide toward Novo or slide toward Pfizer?
Well, both of them want it for different reasons here. As I mentioned, Novo Nordisk really being the laggard here. I mean, if you just look at share performance year to date, stock is down about 46%. Yeah. So you really are seeing, of course, investor base from both companies really trying to see each, investment pull ahead. So it really is important as to whether or not they're able to actually capture Metsera and really get that market share.
I have to imagine, though, that you think about some of the antitrust concerns that could come with Novo actually winning here when it comes to Metsera, that those would be palpable.
Right. I mean, of course, we do know that Eli Lilly, if you think about them, as we were talking about them, they have Zepbound, Mounjaro. Those have been performing pretty well. But Novo Nordisk, of course, they have Wegovy. That's something that hasn't been doing as well and hasn't been keeping up to the likes of the others. But, of course, antitrust still continues to be a concern for these companies as you think about companies taking up too much market share. And, of course, that's something that you'd have to see as to whether or not the administration would actually crack down on something like that.
Whereas Pfizer, for example, doesn't have any presence in the obesity drug market. It'll be fascinating to watch it develop. Our thank you to Bloomberg's market correspondent, Norah Mulinda. Now, coming up, we're about 15 minutes away from those closing bells. We'll take you there with David Bianco. He is America's CIO over at DWS Group. That conversation coming up next. This is The Close on Bloomberg.
There are two major forces that have been moving markets, both equities and bonds, and those are Fed directionality, which depends on labor and inflation, and earnings growth. Today is one of those days where both are being addressed.
Alli McCartney kicking us off to the close over from UBS, Alignment Partners, and I think she really kind of hit the nail on the head. Both of these kind of intersecting on a day, and that actually creates a lot of conflict here for investors in deciding which way to push their portfolio.
Absolutely. At least for right now, it seems like the answer has been to sell stocks, particularly tech stocks, and buy bonds. You're seeing the 10-year Treasury yields now back below 4.10, down about 7 basis points. So at least the relationships between the different assets are holding. I will say that this has been such an ugly day in the S&P 500, and it looks like that selling pressure picking back up again heading into the close.
And speaking of earnings, we get another slew of earnings tonight, though ideally by a lot of mid and smaller cap companies here. Airbnb, probably one of the more notables, but also expecting to get some earnings out of Trade Desk, DraftKings, and Peloton. You still have a Peloton?
I do, actually. I used it this morning.
David Bianco joins us right now, America's CIO at DWS Group. David, I want to ask if you rode your Peloton into work like Katie did, which is very difficult to do, by the way. But I do want to ask you just about economic conditions overall. Sure. Because I think a lot of people are looking at earnings season, particularly in the absence of official government data, as being that economic barometer. Right. And if you look at what we've gotten, it would seem to suggest things are at least okay at minimum, I would think.
Earnings look terrific.
Okay. Does the economy look terrific to you?
No, the economy's still slow. And a day like today exemplifies that. There are concerns about the economy, softening in the labor market, the shutdown continues, disruptions in travel. What does this mean for the holiday season? So you see in the market today some concern for ordinary businesses and causing stocks to sell off. And at the same time, there's concern for the technology and the data centers and the AI universe, because we keep hearing, no matter how big we think these numbers have gotten, they just keep getting bigger and bigger in terms of the CapEx. So the CapEx is helping to fuel the economy. However, the more CapEx, eventually there needs to be a return on an investment, a profit associated with it. So the more these companies spend, the more investors want to hear about the profits soon to come or eventually come.
But that's the big risk, though, right? I mean, if you have so much of the economy and so much of our markets sort of reliant to a certain extent on this CapEx spend, at which point out a lot of this are pledges to spend this amount. Right. But the fear, of course, is that a lot of these companies can just flip the switch tomorrow. I mean, they can go out and say, look, okay, I know we told you we were going to spend X billion dollars, and, well, maybe not.
I think a lot of the companies are maintaining their optionality on how much they continue to spend and which data centers they might buy or lease as time goes on. But in the meantime, there is a lot of CapEx occurring. This year, probably about 0.5% of GDP growth has come from everything AI, data center, chip related, building the data centers, outfitting them, and so forth. So this is the reason why we've had incredibly good earnings growth, not just out of the digital businesses, but the technology equipment companies. And the past couple of quarters were good, but the third quarter was amazing, and some of them said just more to come. However, the valuations are very demanding, yet we understand why, and we're taking a constructive view on tech and communications and all that, but our preferences are financials, healthcare, and electric utilities, because power is still a really important part of the AI story.
Well, I want to talk about financials, but before we move on, I do think that there's a bear case that we've heard built when it comes to these massive deals that we're talking about, the circularity of spend and the risk of overbuilding here. And if you're an investor who sort of stacks it up and falls on the bearish side of those things, how do you hedge that in a portfolio? What actually works? Because it feels like what we're talking about has started to really spread out into all sectors.
Well, we're trying to find the smarter, more selective ways to play the theme that we do believe in, which is AI. Trying to, who are the picks and shovels plays? Some of them are obvious, chips. Some are a little bit less obvious, electrical equipment, electric power. I think people are just, unless you're attuned to this issue, they're just beginning to realize that we'll probably have a few % of electricity demand growth for many years to come. So there are ways to play it, but you raise a good question. There's been a lot of concern about the magnitude of this capital, what the return on the capital will be, and this is about allocation of resources. And there's nothing wrong with circularity as long as in the end this turns out to be a productive use of resources, and this capital being deployed results in services that add value, produce revenue, but also help produce economic growth. That's going to take time, but these companies are committed to that. And like I said, we're at the stage where you have to keep the right balance of, is the CapEx at a pace too great relative to the emergence of profits? There's a lot of faith in the AI story, but the more demanding the valuations get, the little bit more risk of it becoming a show-me story. And we saw that a little bit with a couple of the big tech names over the past couple of weeks.
It's hard to talk about anything other than tech, but let's talk a little bit about financials, because we did have an election this week, several actually, when you think about all the different local elections happening. There was an interesting note out from TD Cowen that you consider what we saw in Virginia, in New York City, in New Jersey as well, that there was a Democratic sweep, and their view is that actually the financials face a populist risk here, not necessarily from those specific elections, but where it signals potentially the country is going. And I wonder, how you think about those different cross currents when you evaluate financials as a sector.
That's a good question. I mean, we're still in an environment where there's been much more friendly regulation toward banks and big banks. And the big banks have a lot of exposure to capital markets activity, which has been robust, and why their earnings were so strong. Smaller banks, one of the things that smaller banks are struggling with is making sure that the interest they pay to their depositors is attractive enough to keep their deposits at those smaller institutions. So that's something that I think we believe. We could debate when and how much the Fed cuts over the coming year, but we do believe there are some more cuts to come, and we do believe there'll be a steep curve as the Fed cuts a little bit. And when you look at things like deficits and what is a fairly robust CapEx economy, owing to all the capital being used by AI, that there'll be a steep curve, some profits there. But if the Fed cuts too much and it spurs inflation, that's populist risk. And if the Fed cuts too much and people say, I'm not making anything on my deposit base, maybe you start seeing a drain from deposits.
I am curious, though. I mean, which way do you think the Fed's going to lean? I mean, you can make a case for cuts based on the labor market weakness. You can also make a case for staying put, given that inflation is still, for 4 years now, still above the Fed's 2% inflation target, which doesn't seem like much of a target anymore.
Agreed.
Yeah.
And I don't think they should be in a rush to deliver a succession of cuts.
Yeah.
I would agree that they're probably above the normal neutral Fed funds rate, but where they're probably also within a range where we can start debating this just might be the upper end of the neutral range. Take their time. We've got to keep an eye on the labor data. Challenger report was a bit of a concern. But I don't think the labor market's rapidly coming apart, but they shouldn't be in a rush to cut unless there really is clearly more damage in the labor market, because there are risks to what happens to inflation, what happens to the dollar, and there are a lot of people who count on the income coming from their bank deposits.
All right, David, always appreciate it. David Bianco, America's CIO over at DWS Group, counting us down to the closing bells. Less than 2 minutes to go. Stocks now deteriorating as we get closer to those bells, not far off of session lows. I just also want to bring to our viewers' attention, Katie Greifeld, a headline out of Washington here involving those SNAP benefits. So this is the supplemental nutrition program that basically helps to feed those people in need. They've now been ordered to make those funds available to states by Friday. Of course, because of the government shutdown, the government has not actually been paying out those benefits. So a lot going on here, and we got a lot of earnings coming up in a few minutes.
Yeah, just a few minutes, though. Really interesting headline, though, because we've been wondering, when we start to see the impact about this government shutdown, now the longest on record, when we start to see some of the urgency come back when it comes to the lawmakers in this country, maybe, as we get deeper in and we start to consider some of these benefits, the fact that people aren't being paid, maybe that will finally act as a catalyst.
Romaine Bostick here alongside Katie Greifeld. Normally, this is the time where we bring in Carol Masser and Tim Stenovic, but they have not a very well-earned day off today for some reason or another. But pleased to say, joining us here in Studio 2 around the desk is Bailey Lipschultz and Norah Mulinda, who help to cover markets for us here at Bloomberg. And this has been quite a seesaw week here, Bailey. I mean, we talk about a big rally, then a big sell-off, and then now, well, looks like we're going to end the day down a couple percentage points on the NASDAQ.
Yeah, looking at the S&P 500, second day down more than 1%. So as you mentioned, every time we have at least a step forward, maybe dip buying shows up, a deterioration, as you mentioned, a day that ending on the lows so far. So not really what you would want to see. But again, challenger jobs data, not really optimistic.
Yeah, the S&P opened today right around 67.87, if you can believe that. The low of the day was 67.07. It's ending right around 67.20, down 76 points or 1.1% here on the day. The Dow down 400 points or 0.8%. The NASDAQ indices, those are your biggest decliners on the day. Both the NASDAQ Composite and the NASDAQ 100, each down about 1.9%. But the Russell 2000 says, hold my beer, down 46 points or 1.86%. Katie Greifeld, so a smidge below.
A smidge.
Of NASDAQ.
Of NASDAQ.
Yeah.
Let's talk about the S&P 500 and talk to the Circle about it, which is big and it's red today. And
I love when you talk to the Circle.
I'd love to talk to the Circle as well.
Because I don't know what it's saying to you.
Well, let me tell you about it. It's telling you that tech fell by quite a bit today as a sector. We knew that already, but when it comes to the sector overall falling by 2%, consumer discretionary actually had a worse day than tech. We know that I think Amazon lives in that index as well. So tech in disguise. What did do well today, energy and healthcare. Energy up about 0.9%, but overall, a lot of selling pressure on the day.
All right, we have Bailey Lipschultz and Norah Mulinda by our side. They're going to help us walk through what happened today, but also help us with some of the earnings crossing the wire, and that includes Expedia. The knee-jerk reaction, the shares to the upside here as adjusted EPS comes in above the average of street estimates, $7.57. The street was looking for $6.83 on the revenue, or excuse me, on the gross booking side, $30.73 billion. The street was looking for 29.2, so a beat there as well. And the company for the full year giving revenue guidance, upping its revenue guidance, 6 to 7% growth on revenue. Had previously, Katie, seen 3 to 5%.
All right, let's talk about Peloton. Those numbers crossing now, actually raising full year 2026 adjusted EBITDA guidance. You can see shares lower right now, though, as we sort of parse through the numbers here. They see second quarter adjusted EBITDA $55 million to $75 million. The estimate had been for $78.1 million, so a disappointment there. Second quarter revenue seen between $665 million to $685 million. The estimate had been for $661.1 million, so actually a bit higher there. But parsing through it, you can see that there is traders deciding to decide what to do here. You did have a bit of a raise when it comes to full year adjusted EBITDA, but then you sort through some of the different metrics and a little bit of a mixed picture. And you can see that's the conversation going on in the shares after hours, now higher by 3.6%.
Let's go back to the travel and leisure space. Airbnb earnings out for their most recent quarter, the third quarter, a slight beat on revenue, $4.1 billion, a slight beat on the bottom line, adjusted EPS at $2.21 a share. Forgive me, that's That's $2.21 a share. That is a miss. The street was looking for $2.36 a share. The guidance going forward, the company's slightly nudging it higher, $2.66 billion to $2.72 billion on the revenue side for the current fourth quarter that we are in. The street on average, guys, was looking for 2.67, so the low end of that range, pretty much in line with the average of analyst estimates. And it raises a lot of questions here about consumer spending going forward. And of course, we should also just be remiss in not pointing out that we got some issues at the airports apparently coming up too. So we'll see if that affects travel.
Yeah, it'll be interesting to see if management talks about that on the call, if in any way, shape, or form. Right now, up about 3.5%, call it 3.7%. Options did imply a more than 7% move. This is a stock that has been kind of moving sideways, if not down, really, when you look at where it's been trading so far in the last 12 months, down about 15%, Nora. So maybe a bit of short coverage, maybe a bit of optimism around the path forward, but it's kind of a mixed picture if you're looking in the travel and leisure space. Definitely
a mixed picture, but I mean, if we're thinking about the broader consumer right now, we have been seeing earnings that keep coming through, underscoring the fact that the consumer continues to be very financially strapped in this time period. So it's not surprising right now that we are seeing this mixed picture here for Airbnb as we think about travel and leisure.
Yeah, it's kind of interesting, though, to marry Airbnb, what we're seeing right now in shares, still higher. Then you pair that together with what we're seeing in Expedia, up by nearly 15% after hours. Certainly, traveling is a mixed picture, but at least in these two names, you can see that the demand is strong. I will say with Airbnb, this is interesting, that they recently launched a Reserve Now, Pay Later feature to book trips in advance theoretically, and you can see that the company is saying that, you know, U.S. travelers have been using that since that feature launched in August. So again, another interesting note when it comes to the consumer and how much they're willing to spend and how, Romaine.
Yeah, that resilient demand here. And it was kind of interesting. We were getting some commentary out of some of the airlines that were kind of trying to prep some of their travelers for the idea of a cut in capacity here. But they also kind of sprinkled that with this idea that they are also seeing relatively decent demand as well. And of course, we're heading into typically kind of mid-November through the end of the year, the busiest travel times, at least here in the United States of America.
And just want to call out in the Bloomberg News article, the head of Expedia saying that the outlook doesn't factor, the U.S. government shutdown, but that they aren't seeing an impact so far. So while we are waiting to see what happens with airlines, we're a month in to this shutdown. So not seeing at least government workers or others pulling back on spending. So that's at least optimistic if you're looking at Expedia.
Another headline crossing the wire right now, Take-Two Interactive reporting earnings. And the headline, well, it's not about their earnings. It's about Grand Theft Auto 6. And surprise, it's being delayed. The company now saying that it's delaying the release of Grand Theft Auto 6 until November of 2026. So you're going to have to wait another year for that based on this. And of course, there had been a massive speculation that they were going to miss this deadline to begin with. We should point out, if you care about the earnings themselves here, it looks like they did beat on several key metrics in the most recent quarter, including on adjusted EBITDA. But the guidance going forward, you're going to have to wrestle with that just a little bit here, particularly as the company raises the outlook for fiscal 2026, but at the same time saying that one of its biggest franchises is going to be delayed. Its next iteration, I should say, is going to be delayed by about a year.
And I'm a big fan of GTA. When you have to tweet that you are apologizing for the delay and that you want to get the game in the final polishing notes, just want to call out that we're delayed to this time next year. So it's not even pushing back another week or two.
I was thinking someone, a specific type of person, is probably really disappointed right now. And turns out he's sitting to my left. It's Billy Lipschultz when it comes to that delay. I can't say that I'm a huge gainer, but let's talk about Texas Roadhouse also reporting earnings. Third quarter EPS coming in at $1.25. The estimate had been for $1.28. So a bit of a disappointment there. But it's really interesting when you think about some of the numbers they broke out for their different measures of inflation. They see full year commodity cost inflation about 6%. They had previously seen 5%. And this is interesting, too. Their wage and other labor inflation for 2026 seen between 3% and 4%. So certainly tells you about all the different cost pressures that are still in this economy as reflected through the lens of Texas Roadhouse.
Well, Katie, let's keep looking at what's going on in the restaurant space and looking at shares of Sweetgreen. We're seeing them plunging for double-digit losses here in the post-market trade. We're seeing shares down more than 19% right now. And this, of course, is after the company is missing expectations of pretty much across the board. Take a look at third quarter revenue. They're reporting $1.72.4 million against estimates of $1.7.5 million. So you are seeing a miss there in revenue, but you're also seeing third quarter loss per share at 31 cents. That's against estimates of a loss per share of about 18 cents. And so you are really just continuing to see a lot of these consumer companies, a lot of the retail, the food companies really struggling right now in this time period.
Yeah, this is going to be a big story, particularly as we get deeper into the earnings season and more of the food companies and, of course, more of the consumer-facing companies report. I do want to go back to the tech space. We were talking about video games, and if you're playing those online, Akamai is a big part of the reason why you don't get the lag. Those shares not lagging at all, up about 7% in the after-hours trade as EPS beat pretty mightily, $1.86 a share. The street was looking for $1.63. Revenue also coming in above estimates, slightly above estimates at $1.06 billion. And here's your guidance going forward for the fourth quarter. The company says adjusted EPS in a range of 165 to 185. The bottom number, the low end of that range, is higher than the average of street estimates.
You can see shares really moving higher after hours for Akamai. I do want to talk a little bit about Wynn also getting those earnings as well. Boy, they're coming thick and fast right now. Wynn Resorts third quarter adjusted EPS missed estimates. The number came in at 86 cents. The estimate had been for $1.16. So quite a miss there. But when it comes to the third quarter Las Vegas operating revenue, that came in a bit better than expected, $621 million. The estimate had been for $602 million. So a beat there. It also looks like third quarter operating revenue beat estimates as well. So you add it all together, shares up mildly right now, about 1.2%.
Well, let's look at Open Door Technologies. Of course, this is a stock that's really been in focus quite a lot this year, really being wrapped up in the meme stock rally here, or really the highlight of that rally. We're seeing third quarter revenue coming in at $915 million. This is against estimates of $852.9 million. So, of course, we are seeing a beat there. But what people are looking at right now is a third quarter loss per share. We did see of 12 cents. This is against estimates of a loss per share of 7.6 cents here. So you really are seeing shares kind of volatile right now in the post-market trade. But we are seeing them at down about 8% right now.
All right. Thanks there to Norah Mulinda and Bailey Lipschultz, who helped to lead our markets coverage here at Bloomberg. And I'll just throw another one into the ring before we go to break. Block out with a forecast saying that they see adjusted operating income for the full year at about $2.06 billion. That's slightly higher than what they had prior to that. When we come back after the break, we're going to dive deeper into those earnings out of Airbnb, a conversation about the state of the housing market and, well, the state of travel as well. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. A down day in markets. In fact, we closed right around session lows for most of the major indices, with the S&P dialing back by about 1.1%. A big downdraft today in the NASDAQ indices, down about 2%, largely because of a big sell-off in some of those tech names. It's not on the board, but I do want to point out also that the Russell 2000 was also down about 2%. And that was largely because a lot of those cyclical stocks got hit because of concerns about the state of the economy. You saw that reflected in the move lower in yield as people anticipate that some of the relatively soft data that we got today with regards to the state of the labor market and those job layoff numbers, that could maybe give the Fed more ammunition, Katie Greifeld, to continue cutting interest rates.
Absolutely. That's sort of the logic that's been percolating around in markets today. Let's take a look at some of the notable movers in the after-hours trade. We are very much still in earnings season. We're awaiting earnings from DraftKings. That'll be an interesting one to watch. You can see shares up about 0.5% in the after hours. Earlier today, ESPN did sign DraftKings as its new sport betting partner. Be interesting to see if we get some commentary on that in the call. I do want to highlight Sweetgreen, one of the names that reported, and they cut their 2025 outlook. Sales falling more than expected, shares falling about 9% at the moment. And I end with Airbnb, up 4.5%. It's actually seeing travelers book vacations further in advance. That is one of the things working its way through the shares right now. Overall, you can see Wall Street pretty pleased with the results so far.
Yeah, absolutely. Here, and we talk a look at some of the big names moving here on the back of that, and Airbnb is out front. Of course, a lot of questions right now about the state of the housing market and the state of consumers when it comes to travel. Amy Nixon joins us right now, housing and economic analyst over at DFW, a Dallas-based economics and housing analytical firm. Amy, when we look at Airbnb, I always kind of don't know what category to put them in. I mean, are they a travel and leisure company? Are they a housing or a hotel company? I mean, they would tell you they're none of that. They're just, a platform. But you can get a pretty decent read to a certain extent on economic trends and housing trends. And when you look at their report today and some of the reports that they've given us the last 2 quarters here, what is that telling us?
You know, it's interesting because I actually asked that question to my followers on X, and I got so much pushback and dissent. Like, is this a tech stock? Is this a real estate stock? Is this a sort of travel hospitality stock? Nobody was in agreement on that. I think they consider themselves a tech stock because they do own a tech platform. They don't own any real estate. They don't transact real estate. I think they're kind of a uniquely positioned company in that sense. And I think that that's why they've actually done pretty well in this higher interest rate environment over the last couple of years. They've had mixed earnings for the most part. Like we saw today, there was a little bit of a mixture in the earnings. Some of it was a beat, and some obviously Wall Street liked it. But I think in terms of, the travel industry, it's held up really well overall. And you have to remember that, again, that circles back to that consumer spend. And the consumer spending has to do with, that top 10%, which again, I think is responsible for like 50% of consumer spend. Yeah. And then that bottom, 90%. And then where does Airbnb's customers fall in there? They're kind of in both. But the thing to look at going forward is young people. That's a big part of their demographic. Those are probably the people that are using that buy now, pay later option that you guys were talking about earlier. And those are the people who have the worst unemployment rate right now. Right. They have the highest level of credit defaults right now. So can they sustain the same travel enthusiasm that they've been doing so far for the last couple of years? That's the question.
Well, Amy, the question I have about Airbnb is about quality. You clearly spend time on social media, and among that younger cohort that you reference, I mean, there's memes about Airbnbs, the type of issues that you run into there, and sort of the fees that some of these homeowners, these Airbnb owners, layer on top of the original bill. And I wonder, how Airbnb can ensure the quality going forward to compete with hotels if you view that as who they're competing with.
They are competing with hotels, and there's actually been a resurgence in hotels amongst the millennial generation because you have seen a lot of bad press for Airbnb because of these high cleaning fees and these arbitrary rules. And sort of Airbnb is a platform, and they step back. They kind of let the host and the guest duke it out when it comes to conflict. So there can be very varied experiences when you rent a property. Is your host going to be generous with like their policies, or are they going to be a stickler? Are you going to have a good or a bad experience? Airbnb is a little bit hands off in that. So hotels have had a little bit of a resurgence because they have a more consistent customer service experience. And I think going forward, there's always going to be demand for Airbnbs because they are unique and because a lot of people want a large property where they have a kitchenette and they can bring a family. But it is going to be interesting to sort of see if there's a divergence where, people start to go back to hotels more than Airbnbs, or if they sort of both stay popular in their own right.
All right, Amy, really appreciate your instant analysis here. That is Amy Nixon, housing and economic analyst at DFW, reporting, of course, on Airbnb. Shares up about 4.6%. Romaine, they're not the only one reporting.
Meanwhile, DraftKings moving to the downside here, a miss on several key metrics. While revenue did come in at about $1.14 billion, that was light. The street was looking for $1.22 billion. The adjusted loss per share also wider than what the street was looking for, 26 cents loss versus an estimate of 21 cents. And the full year revenue guidance range, 5.9 to 6.1 billion. That's lower than the previous range it had given just a few months ago when it had said it would get 6.2 to 6.4 billion. DraftKings down about 10% in the after hours trade. Some of the other gaming stocks like Flutter also moving lower.
And let's take a quick look at Microchip here. When it comes to the second quarter, adjusted EPS and net sales beat estimates. The reason the stock is down right now, though, is because the look ahead. Third quarter net sales seen between $1.11 billion to $1.15 billion. The estimate had been for $1.18 billion, so disappointment there. So, too, when you take a look at third quarter adjusted EPS expectations between 34 cents to 40 cents. The estimate had been for 39 cents, so the midpoint of that range below below the prior estimate, Romain.
A lot going on here in the after-hours trade, still awaiting the outcome of that Tesla annual shareholder meeting. It has begun down in Texas with Elon Musk's pay package, the primary issue that they'll be voting on. We'll bring you full coverage of that as soon as we learn the details. Stick with us. This is The Close on Bloomberg.
Travel companies on notice as the FAA announces the U.S. will cut flight capacity by 10% at 40 high-volume markets. Our next guest has a unique perspective on this from their seat as the CFO of the leading business travel management platform, Navan, which just made its trading debut days ago. Amy Butte, she is Navan CFO, joins us now. Amy had previously helped spearhead two major IPOs, including the transition of the NYSE to a public company back in 2006. Amy, great to see you in person.
Great to be here. Thank you.
So there's a lot to talk about when it comes to travel, but I do want to talk a little bit about the decision to go public. It feels like we're still coming out of a period where you really saw a dearth of IPOs. That has started to change a little bit. I know that the shutdown is maybe gumming up the mechanics there, but talk us through the decision. Why now to enter the public markets?
Sure. I'm a big believer in the public capital markets, as you mentioned. And there are lots of benefits to being public. You know, access to lower cost of capital, branding event, maturation of the company, as well as an acquisition currency. And Navan is really poised to benefit from all of them, which will help us grow and help our customers as we look to disrupt this space.
Well, let's get to the idea, though, too. I mean, we were just talking about Airbnb, which is, predominantly leisure travel. And there's some concerns that we might be seeing some cracks in there. When it comes to business travel, are you seeing any material pullback at all?
Well, it was funny. I was flying yesterday to Boston. I actually had a mechanical error on my problem on my first flight. Was on the second flight, and I was talking to the flight attendant, Bernardo, and I said, "Are you seeing a slowdown in business travelers?" And he said, "Not at all." He's like, "Road warriors are road warriors, and they're very different than consumer travel." And it was really interesting because our business travel index showed that. September to September, BTI was up 20% year over year, and TSA data, which is what we measure it against, was only up 0.6%. So, we believe that there is a big difference between that business travel and that consumer travel.
But you also know, I mean, when economic times get hard, everyone pulls back, not just consumers. Companies start to, scrutinize your receipts a little bit more than they should, maybe. But it gets to this idea that if we're not going to see a retrenchment in business travel, is there a sense here that the leisure travel, the potential loss of leisure travel will actually hurt the industry? Or is there enough, I guess, in the business pipeline to kind of make up for that?
So Navan is focused on the frequent traveler. It's focused on the business traveler. And we're not seeing those trends as evidenced by the BTI. But I love hearing you talk about CFOs being more concerned about cost, because I get to talk to CFOs about doing three things. One, saving money. We save companies about 15% when they move to this more modern travel versus legacy. Saving time. It takes only about 7 minutes to book a trip versus 45 for the legacy players. And we get to make people happy because you don't have all those receipts, and we have a very high CSAT of about 96. So I think it all plays together. We believe that one-on-one and group connections are here to stay, and that's evidenced by the BTI data.
I do want to go back to the public versus private markets, because this is something that I think about a lot. And given your experience in the space, your experience taking companies public, one of the narratives that is out there is that you are seeing a structural shift in the way that companies access funding, that you can stay private for much longer, in some cases never go public. And I wonder if you agree with that assessment, that there is something structural going on, or is this cyclical and we're going to see the limits of how much you can really stay in the private markets?
I agree with you. There is a structural shift. The amount of private capital today versus 20 years ago is materially higher, and companies can access it. On the other hand, is that ultimately good for the markets? I think it's good when you have more choices as an investor. And is it ultimately good for these companies? Maturation is one of the key items that's really important. And I think you've seen some companies in the past, Uber might be a great example of, if you don't mature at that normal state that you would have as a public company, that's going to create problems later on, not just for you, not just for investors, but also for customers.
Do you think we're going to see a material pickup, though, in new issues? I mean, when you're at the NYSE, I don't know how many more publicly traded stocks there were than we are today, but it's gone down significantly.
Significantly gone down. Look, you're talking to someone who, Navan survived COVID. We got public in a government shutdown. We've got a lot of grit. We always find a way for ourselves and our customers. I believe it's a good thing to see more companies come to the market, and there's a big pipeline behind us. I think the banks would be better positioned to tell you all those numbers, but I think it's the right thing to do.
All right, Amy, this was great. We didn't get a chance to talk about, actual entertaining and dining and what you're seeing in those trends. That's where I have my beef with my receipts. Amy Butte, CFO of Navan. We'll be back in a moment. This is The Close on Bloomberg. All right, we're keeping an eye on the government shutdown in Washington, day 37, the longest in history, leaving government funding hanging in the balance. Our next guest works closely with the government and as one of the biggest infrastructure players in North America, the largest building materials business in North America, to be blunt about it. Jim Mintern joins us right now on the heels of earnings out of CRH. The CEO of CRH joins us here in studio, too. Great to have you.
Thank you, Romain. Great to be here.
Absolutely. I first want to start with earnings and just kind of talk a little bit about what happened in the most recent quarter and whether that continues for the next couple of quarters going forward.
Yeah, we put our Q3 results this morning. So a strong Q3 for us. Revenue up 5%, EBITDA up 10%, and 100 basis points margin expansion. We actually upped our guidance for the full year, tightened the range, and we upped it to 7.65 billion. That's a double-digit growth year for us, Romain, coming off an excellent 2024 as well. So it's a record year for us in 2025, and our 12th consecutive year of margin expansion. Now, what's driving that? What's behind that? Infrastructure is busy. You said it. We're the biggest, one of the biggest infrastructure plays in the US. Particularly when you think CRH, think roads, think water and roads infrastructure, and then reindustrialization, data centers. So that's what's really underlying that.
We're going to get to data centers in a second. I do want to talk about roads, just because we are in the middle of a federal government shutdown. And I would assume most road projects, at the state and local level, at some point originates with federal dollars. Does that affect you at all, the shutdown?
Yeah. The federal funding, we're still in the IIJA bill just right now. About 60% of the IIJA bill has not yet been spent. However, the Highway Trust Fund is a separate revenue stream into the local states. So actually, we've been through a few government shutdowns before. Obviously, this is the longest. So it doesn't actually impact the funds of federal flow into the states for the road program. So no, it doesn't impact us.
Let's talk a little bit about data centers, because obviously that was a hot topic when it comes to your earnings call. And I wonder, what has the shift been like, the shift in focus? Because data centers, I don't think we were having these conversations 2 years ago. Even at the pace that we're having them, I don't know if we were having them a year ago at this time. So give us some color on what that conversation internally at CRH sounds like.
Yeah, it's exciting, Katie. We have a national footprint. We're in 48 states. We have 2,000 locations across the US. So in fact, every single data center in the US is within 50 miles of a CRH location. Right today, we're actually active on 98 individual data centers just right now. Now, they're all at different stages of completion, but for us, and this is where we're maybe slightly different, we're often one of the first people on site. So we put in initially all the kind of water, the energy, and the communications infrastructure subterranean, and then we come on top of it with our aggregates or cement and concrete. So, it's that connected nature of our portfolio really plays into the sweet spot of data centers. And I think, if you're building a data center right now, what matters is quality and speed, and that's what we can offer given our national footprint.
The big question when it comes to data center, and really when it comes to the whole AI build out, is whether or not it's sustainable. So if you take a look into 2026, how big of a contribution will the data center build out be to your business? How does that compare to what we've seen in 2025?
I think 2026 is still going to be very strong for us on the whole reindustrialization data center. We see that in terms of the backlogs we have into that. So 26, from our perspective, looks good. And building off a very good 25. We saw it ramp up in 25, and it'll continue into 26.
I am curious about just other areas outside of data centers, and I mean, you have other things, a couple big chip plants. I know one down in Texas and another one somewhere out west somewhere that I'm probably forgetting. Boise, Idaho, thank you. But there's been this whole push, particularly under this administration in Washington, to reshore a lot of manufacturing capacity. And I know it's kind of come in fits and starts. Without getting into the politics of it, are you anticipating that we will see a meaningful uptick in demand for new manufacturing facilities, whether it's something as high level as chips or maybe even something that's just more pedestrian, like a warehouse?
Yes, Roman, we are, and we see it, right? Whether it's data centers, chip plants, right, into EV battery plants, we see that, right? And I think these are multi-year projects. Now, what excites us most, we've seen this time and time again across our portfolio. A chip plant is wonderful, right? It's a super big project, but actually the whole infrastructure that goes in around that can drive construction for kind of 3-5 years. You think of the residential, the kind of road network, into retail network. So we get many years post the initial chip plant, and that's what makes it particularly exciting for us.
When I go through a list of all the big projects going on around this country, and I think about the people power needed to build those things, even before this big boom, we were seeing a labor crunch in the construction sector. I am curious as to how you're finding the workers, and more importantly, if you're having to pay them materially more than what you would have maybe a couple of years ago.
Again, it's probably not so much for us because we've 2,000 locations, but we tend to be in rural locations, so we're big employers in local communities. So we have a very low turnover of employees. It's probably more for our customer where we see it, right? And there is some impact, but not directly on us per se.
And it's interesting, obviously the government is shut down, so we're not getting non-farm payrolls figures, but for the last several prints, what about the farm payrolls? I still don't have an answer for you.
I tell her that joke every day. She never laughs.
It never gets old, though. But you had seen just this continued contraction when it comes to manufacturing sector jobs. So really interesting to hear some color there. I do want to talk about M&A because, boy, you have been active. I was taking a look at this stat that your CFO gave on the earnings call that so far in 2025, you have 27 deals so far.
Yeah.
Are we going to see 27 more in 2026? What's the plan?
That's not unusual, Katie. Last year we did 40, right? We did 27 years.
So you're behind, is what you're saying.
But the pipeline is good for the remainder of this year and into 26. It's an interesting stat, right? We've done over 850 acquisitions in the US, right, in the last. So we typically would do, maybe 30 deals a year. It's a real core part of who we are in terms of CRH, and it goes back to actually the connected nature of the portfolio. We have a lot of optionality where we deploy capital, and that kind of, we've got a lot of local brands across CRH, and what's interesting, those deals, most of them bubble up from the local brands. We're here in New York, we're Tilcon, right? That's the local brand name here. Those deals come from the kind of bubble up from the local operating business.
It's fascinating. And, while we have you, one of the reasons that I like to follow CRH is because I feel like you guys started a trend of switching your listings from overseas to the U.S. You were CFO when CRH completed that transfer to the New York Stock Exchange in 2023. And again, I feel like you were at the forefront here. So take me back to 2023 and that decision. In hindsight, the logic makes sense, but I wonder how it was perceived at the time.
Yeah, it was the logical move for us, right? 75% of our business is in the US. We are number one globally, but we're number one in the US, and number one in infrastructure. So if you were starting today, you would have always listed CRH in the US from that perspective. But it's been an interesting process, and I think that's probably the key word. It wasn't an event. It's a process, and it's still ongoing. Right. I mean, 2 years later, we're still working our way through the process. It's been very successful, both from a kind of a talent attraction, a business commercial aspect side of it as well. In terms of M&A, right?
Yeah.
People want to deal and sell their businesses to US listed, New York listed companies.
Well, Jim, I wish we had more time because I think it is just such an interesting topic. Come back soon. That is Jim Mintern. He is the CEO of CRH.
I had 6 more questions.
I know. There's never enough time. Let's blow the break. Just kidding, in the control room. Anyway, let's look at some of the notable movers in the after-hours trade because earnings season, it is still ongoing. You can see we have some big movement here in the shares of Block, down nearly 10% at the moment. Clearly some disappointment coming through there. DraftKings also also lower after reporting their earnings. They did announce their intention to launch DraftKings predictions in the coming months. We know that prediction markets may be an existential threat to some of these betting platforms.
Yeah, and I think that's going to be a big story. We're still focused on the consumer as well. Softness there in Sweet Green down 8%, some softness in Texas Roadhouse. And how about Microchip? Remember that was kind of the darling stock for a little bit? Yeah, down about 6% here in the after hours trade.
All right, this is the close on Bloomberg.
New York, I pray that the policies that Mamdani uses to govern and lead New York are different than the talking points he used to win the mayoral race. The people of New York deserve better. And I really hope that when Mamdani thinks about leadership, he thinks about the right role models. And there's a lot to copy from our great state of Florida and from this great city of Miami.
Citadel CEO Ken Griffin, who for a certain extent has kind of become the poster child for people fleeing cities like Chicago and New York for what they see as greener pastures. Of course, Griffin's comments coming as Zohran Mamdani's mayoral term as in New York City is set to begin in just a few weeks, and the city now trying to digest of what the impact of his administration will be. Our next guest says strong economic initiatives are paramount to keeping the city running. Pleased to say joining us right now is Abby Joseph Cohen, Columbia Business School professor, former partner and chief U.S. strategist over at Goldman Sachs. Great to have you here, Professor. I do want to start off here with Wall Street specifically, given the decades that you spent there. That has been financially one of the main drivers of this city. One of our Bloomberg Opinion columnists has some great data out showing just the attrition that we've seen in that industry and the idea that some of the new industries that have moved in don't necessarily carry the same high net worth individuals that we saw in Wall Street. And I am curious as to where you think the balance is and how Mamdani can actually address that.
That's a very big question. So let me start at the beginning, if I may. The first mayor to recognize this as the trend was, in fact, Michael Bloomberg. When he became mayor several years ago, he basically saw, perhaps before anybody else, given his role on Wall Street, that the financial community was changing. The role of computers, changes in regulation, changes in competition, all meant that growth in terms of jobs in the financial services community was likely to erode somewhat, and furthermore that there would be out-migration from the city as several companies would decide to put their workers in other locations. What did he do as mayor? He identified several industries that he thought could grow and could do a few things. Obviously, job growth and also income support. Now, when we talk about the jobs that replace financial services, we have to recognize that there's something else happening in the city as well. And that is, as Michael Bloomberg identified, there was a need, and this is something that Mr. Mamdani has identified, is there's a need for jobs for people who are not at that high end of the income spectrum, who are not at the highest end of the educational spectrum. What we began to see under the Bloomberg administration was a focus on good policing and on keeping the streets safe and clean. And the idea was to build a very strong tourism industry. And before the pandemic, we were up to about 60 million visitors a year in New York City, an enormous source of jobs, an enormous source of income coming into the city as well. What do we look at now? Well, something else that happened under the Bloomberg administration was a focus on high tech.
Yeah.
There was this recognition that for a city that had terrific universities and a city that was the heart of the financial community, we were in fact underplaying our potential role in high tech. Among the things that the Bloomberg administration did was to create a brand new university right in the heart of the city called Cornell Tech.
Yeah.
And the idea was to be a magnet for the best graduate students around the country and the world to focus in on high tech. And in fact, right now, Cornell Tech is one of the leaders in things like AI and in a number of other important categories that will create jobs and income going forward. And by the way, Cornell Tech has already created hundreds of new companies for the city of New York.
Absolutely, too. And just a reminder to our viewers, if it's not obvious, so Michael Bloomberg, of course, is the founder and owner of the parent company of the network you're watching right now. There's our disclaimer. Of course, also former mayor for 12 years. And now, he's been gone for some time. Abby, we had 8 years of Bill de Blasio, 4 years of Eric Adams, and now at least 4 years of Zohran Mamdani. I am curious about how he can continue that diversification of the local economy. Do you think it will be a tech focus, or, as you just kind of alluded to, more focus on some of those middle income and lower income services and manufacturing jobs?
I'm not quite sure what Mr. Mamdani will do as he governs the city. We all know what he campaigned on. I would urge everyone involved to focus in not just on how you slice up the pie, but growing the pie. And I think that in the city of New York, you take advantage of the great university systems, number one. Number two, the fact that New York is a magnet for incoming individuals, migrants into the city and the country, and also capital flows. 2/3 of the working PhDs in the United States in categories like medical research and also engineering and applied sciences, they are immigrants. Not the children of immigrants, but these working PhDs in the United States are themselves immigrants. New York City is the #1 place where they come when they arrive in the country.
Right.
And so I think to take advantage of this strength is something that a Mamdani administration should be looking at, number one. Number two, I think they should be taking advantage of the strong universities that we have in the city and in the suburban areas around the city as well. And number three, the workforce. We have some terrific people at all ends of the income and education spectrum, and to focus in many cases, on what can be done to enhance the job opportunities for people in the middle income and lower, because I think that will help deal with the affordability crisis that he identified. Affordability is not just a function of the price of things, it's how much can you afford, which is also a function of how much do you earn.
Well, Abby, we only have a couple minutes left with you, so I do want to broaden this conversation to the national workforce, because you're certainly starting to see some concerns there when it comes to the pace of job creation slowing down. Maybe some signs out there, certainly in the Challenger data this morning, that job cuts are picking up. But when you take a look at the balance of things right now, I wonder, if you see a bigger problem when it comes to demand for labor or supply of labor when you think about some of the immigration policies of the Trump administration.
We certainly are running into issues having to do with the supply of labor, but that feeds into the demand of labor as well. What we know, of course, is that the data that we're seeing from private sources is not nearly as robust as we would be getting ordinarily from the Bureau of Labor Statistics. But we'll have to do the best we can with that limited data information. And what it does show is that larger companies are now beginning to say they're not hiring very much. What we're not seeing is what's happening at the smaller company level. And there is some anecdotal information suggesting that that's where people are losing their jobs. Now, is this a function of tariffs? I don't know. But clearly it's something where we are, I have to use the expression others have used, and that is we're flying blind a little bit right now in terms of that information. With regard to your question about immigrants, before the pandemic, 60% of the increase in the U.S. labor force in the 10 years prior to the start of the pandemic were immigrants to the United States. And let's keep in mind that so many of them were at the upper end of the education spectrum, not just those PhDs I mentioned before, but many people coming into the United States with master's degrees and a number of professional degrees as well. Medical research and medical practices in the United States rely very often on nurses and doctors who have been trained outside the United States and are looking for opportunities to work here.
Right. Well, Abby, we have just over a minute left, and I do want to bring this conversation to the stock market because you're looking at an S&P 500 that's up double digits year to date, and certainly there's a lot of optimism priced into the big benchmark right now. When you think about some of the concerns percolating in the economy, in the labor market, how does that possibly get expressed in the equity markets as we head into year end?
Well, you've already asked some of the economic-related questions. Some of the market-specific questions have to do with the concentration. We've talked about this before, where the weightings of certain companies have continued to grow and grow, which means that the vulnerability to those companies is enhanced if they have disappointments. Of course, the opportunity in those companies is enhanced if they do well. And when we take a look, for example, at how companies are reporting, and I was interested to listen to some of the very significant aftermarket comments that you made just a few minutes ago, just the very sharp responses on the downside when companies disappoint. When you have when you have high full valuations in the equity market, there's no cushion for error. There's no margin for a mistake. And I think that investors right now need to be careful in that regard.
Yeah, it certainly feels that way. As you mentioned, looking at some of the after-hours reactions underway right at this moment. Abby, great to get some time with you. Hope to speak again soon. That is Columbia Business School professor Abby Joseph Cohen, former partner and chief U.S. strategist at Goldman Sachs from Boston.
I want to take a class of hers.
I do too. I know. We got to get her in studio and just talk to us for an hour. Great conversation, though. And she makes a great point that expectations are very, very high in this market. And we're going to continue to follow, of course, how that all plays out in the after-hours trade. This is The Close on Bloomberg.
Elon Musk's $1 trillion pay package has been approved by shareholders. A controversial pay package that effectively would allow him to ratchet up his ownership of the company from roughly about 13% to almost 30%, including a $1 trillion payout over the course of several years that has now been approved by shareholders.
And this is the largest payout ever awarded to a corporate leader. Really interesting vote, finally getting the resolution here. We know that some of the big proxy advisory firms had come out against it, recommending that shareholders vote against it, but clearly the retail base making its voice known here.
In order to get that $1 trillion, he has to hit several milestones, including getting the market valuation of that company up to $2 trillion, and at some point over the years, maybe as much as $8.5 trillion, 20 million vehicles delivered initially, and that would ratchet up even further. We're going to have more coverage of this coming up in just a bit. I believe in Balance of Power, which starts at the top of the hour with Joe Matthew. But once again, the main headline here is that $1 trillion pay package for Elon Musk at Tesla has been approved by shareholders.